It's Sunday, May 8th, 2022. This is All About Your Benjamins and your weekly mixtape and weekend review video. First off, I want to say Happy Mother's Day to all of the moms out there. I called my mom, who's visiting my grandmother out in Pennsylvania, spoke to both of them, and obviously we took care of Ange today and made sure they all had great Mother's Day. So hopefully you had a great Mother's Day if you're a mom, and if you're not a mom, hopefully you called or hugged or talked to your mom and took good care of her as well. Let's get to the headlines that may or may not be impacting your financial plan and portfolio. And as you can see below, we've got 5 headlines. I'm not going to go too deep into them because they don't need a lot of commentary right now, but the first one is going to be the Fed. So the Fed raised rates this week by 50 basis points, so by 0.50. The rates went up by that much, and the market initially loved it. The market had a 1,000-point day up in response to the Federal Reserve raising rates. So some of the reasons for raising of the rates, we already knew they were going to be doing this. The main reason you see them raising by 50 basis points instead of 0.25 basis points or 25 basis points is that it's them trying to stay ahead or maybe even catch up of inflation. I would say probably more catch up and control rather than stay ahead, since inflation is higher than what they really want it to be. Remember, 2% is the goal. So we're sitting up at 8%. We'll see what the new numbers are for the last month and see if it's come down some. We have some experts out there who think we may have peaked, although peak doesn't always mean it comes right back down. You can peak and stay at a plateau for a while. But nonetheless, Reserve raised rates. Now, one of the things that's interesting to pay attention to is their commentaries that they took a 75 basis point raise off the table. So they said they wouldn't go by 0.75. So the next raises we will see, if we will continue to see them, will be either 0.25 or 0.5 raises. Probably going to be more along the 0.5s, but we will see. So they did what we thought they were going to do. The language wasn't overly aggressive. It wasn't also very conservative. So we'll see what continues to go forward on that end. Again, not a job that I want to have. It's tough to get it right. You don't know if you have it right until hindsight, and all the while you're doing it, everybody debates whether or not you're doing the right thing. And most people are going to be critical of the decisions that you make. So hats off to them for doing this, and I'm hoping that they do things right or as best as they can to minimize the financial stress that comes to the system and the economy. So speaking of all of this in the market, I mentioned the day of the rise in rates, the market was up 1,000 points on the Dow. We shouldn't do points anymore. It should be percentages. I think it was a 5% gain in the NASDAQ, but nonetheless big gains. The next day was a big sell-off, which I wouldn't have publicly said it because I don't try to make market claims, but I was not surprised to see the market give back pretty much all of the gains the next day with a sell-off. So what you see right now is kind of typical in a kind of bear market. Most of the time, your biggest 1 point day in the market, the biggest point or percentage gain day in a market usually happens during a bear market. And bear markets are not something to be afraid of, as we already know they're normal, but bear markets happen regularly. So we're pushing that level when it comes to the S&P 500. We talked about it before, the NASDAQ is already there. So nonetheless, the market has continued to sell off and have its losses, and will probably remain volatile for the foreseeable future. We're off to one of the worst starts to a year in a long time. The next article talks about how the tech the decline in the tech has been one of the worst. It ends a 2-year run, so basically all the gains for the last 2 years have been given back in a lot of your tech stocks. And tech tends to be more volatile, they're more growth heavy, and they're more sensitive to interest rates and inflation going up. So not a surprise to see those sell off. A lot of those stocks were at very astronomical numbers, and they can stay there longer than we probably think they should, and they can fall pretty fast and pretty hard, which is what we're seeing right now. So depending on where you're investing, you may be feeling more pain or less pain than your neighbor. If you're heavy in tech, you're feeling like things are a lot worse than somebody who has just a diversified portfolio. And diversified portfolio is not looking pretty, but it's also not looking near as bad as everything else. And for the most part, a diversified portfolio is holding up. A diversified portfolio doesn't mean you're going to never lose. The goal is to soften the losses when the time comes and not be down as much as you would be if you were fully in one area or fully in equities. So hopefully tech kind of finds a bottom, and we'll see how the recovery looks. It's tough to be bearish against tech, though. If you think about the long term, so much of the future of the economy and business centers around technology. Technology is making businesses better, more productive, more efficient. So it's hard to think that we're going to stop having the need for these these companies. It's just whether or not the valuations we saw last year and the year before are realistic for the long-term future. Obviously, in the short term, the market doesn't think so, which is why the prices have come back down. So we'll see where things settle. We'll see if they recover quickly. We'll see if it's a slow grind or if it's just slow and steady on the way back, or plateaus, or what it might be. But nonetheless, it's the case for diversification. If you chase returns and you were chasing the returns of last year, you might not be feeling really good about it. Again, if you have exposure to the NASDAQ and you have exposure to tech stocks, you see that in your portfolio. But if you're diversified, you see the other areas as well that are balancing that out. And diversification means you're always going to be missing somewhere and be down somewhere. And that's just what we're seeing here. So last year, if you were diversified, you might have been disappointed that you weren't getting the returns that the tech growth areas were getting. But this year, your diversification is probably making you feel better. So it's a trade-off. Depending on your investment goals, that would determine what type of portfolio you need and how much you need to be having in these different areas. But tech is looking pretty ugly right now, and hopefully we'll be finding a bottom sooner rather than later. Going back to the economy, jobs growth, we had 428,000 jobs added, which puts us at an unemployment rate of 3.6%. So we're kind of in this environment where there's a lot of bad news in the economy, bad news in the market, but also good news out there as well, and which one's going to win. Hopefully, obviously, we all want the positive side to begin to overcome the negative side and kind of bring us back, or at least stabilize things for a while, but we'll have to wait and see. But nonetheless, we've got unemployment low, we've got wages rising, inflation on the other side rising faster. We have consumer confidence and spending still holding up. Maybe they're going to come down a little bit, but they're still positive and still good. So we're going to see how things kind of play out over the coming months. And then finally, we talk about crypto from time to time. Crypto is not immune from what's going on in the market, which kind of hits at the debate or the argument that crypto is a diversifier away from the market, from equities. I've never bought into that. I view it as it's a growth, it's a risk asset. So when risk is off, as they say right now, people are selling the risk assets to move to cash and other places. I would expect that crypto would get hit as well. So I think I saw Bitcoin fell back down to 34,000 per Bitcoin, which is kind of the benchmark, if you will, that everybody identifies with, and that's the one most people know about. So we'll see what happens with crypto. We'll see if it holds, if it goes down. Volatility within crypto is normal. We've seen it fall 80%, I think 3 times in its existence since it started back in 2009. So we'll see how things play out there. But even crypto is not immune from everything going here. So you've got stocks down, bonds down, crypto down. Where's your best place to go? The safest place is always going to be cash, but then cash is losing 8% to inflation. And we know cash will not keep up with inflation over the long run. While yes, cash looks better, not losing principal is better than being down 10, 15, 20% depending on where you're investing. Those areas that are down to 10, 15, 20, we believe over the long run are going to recover and come back, and we'll outpace inflation for a longer period of time. Cash is never going to do that. So the tough thing to do is to try to get in and out of the market. Not to say that you can't do it, not to say that maybe that's not the right course of action right now, but it's tough to move out of the market, sit in cash, wait till things are done and get back in. And a lot of people over the last 5-10 years have been harmed or have felt the impact of moving to cash and not getting back in at the right time. Will this recovery, whenever the recovery begins, be as quick as the ones we've seen over the last couple times of the market sell-off? I don't know. If I had to guess, I don't think it will be. I think that the conditions for this one are a little bit different than COVID and past declines we've had, that maybe it might take a little bit longer to get back up. COVID was a snapback real quick. You had 2008, which took about 18 months. So we'll see how things play out there. But nonetheless, nothing is immune right now from the sell-off in risk assets, which all goes back to having a plan, understanding why you're investing, making sure your short-term needs aren't in the market, that you've got the funds you need in liquid, short-term, risk-less or risk-less, not no risk, but less risky assets, so that you don't have to sell off your investments that are for the long term and give them time to recover. So may not be out of the woods yet. Be prepared for more volatility. Be prepared for more declines, but hopefully stick to your plan. Don't let the emotions overcome you. And I truthfully believe that over the long run, things bounce back as they always have. It's just not knowing when and being in a position to wait that out. So just a little bit of commentary, some thoughts from my end. Hopefully you have a plan, you feel comfortable where you are. And if not, obviously reach out to your advisor or find a financial advisor to work with going forward. That's it for today. Hope you all had a great week. Hope you had a great Mother's Day again. And thanks for tuning in. This was on the podcast as well. So if you ever want to listen to the weekend reviews, those are going on the All About Your Benjamins podcast channel as well. So you can find it on the YouTube channel. You obviously can watch it in the blog, or you can listen to it over on the podcast. With that, have a great week. We'll see you next weekend. And as always, we'll see you in the next episode.